Home Ownership and Equity Protection Act. The Home Ownership and Equity Protection Act was enacted in 1994 as an amendment to the Truth in Lending Act to address abusive practices in refinances and close-in home equity loans with high interest rates or high fees. Since Homeowners Equity Protection Act's enactment, refinances on home equity mortgage loans meeting Home Equity Protection Act high cost coverage tests have been subject to special disclosure requirements and restrictions on loan terms. And consumers with high cost mortgages have had enhanced remedies for violations of the law. In 2010, the Dodd-Frank Act expanded the scope of Homeowners Equity Protection Act coverage to include purchase money mortgages and open-end credit plans. The Dodd-Frank Act also added new protections for high-cost mortgages, including a requirement that consumers receive home ownership counseling before obtaining a high-cost mortgage. Fair Credit Reporting Act. The Fair Credit Reporting Act regulates the action of credit bureaus and the use of consumer credit. If a lender refuses to grant credit or make a loan because of the derogatory information in a potential borrower's credit report, the lender must make that information available for review and provide the potential borrower with the name and address of the credit bureau that supplied the information. If requested by the borrower, a credit bureau must supply all information included in that person's credit file. A person has the right to have an erroneous credit report corrected. Further, the Act limits access to a person's credit file. Community Reinvestment Act. The Community Reinvestment Act was passed to help prevent redlining and discrimination by lenders. The act is designed to ensure that banks meet the credit needs of the community in which they conduct their lending businesses. To comply with the act, financial institutions which are supervised by federal agency, must make a responsible percentage of loans in their community and immediate business area and must prepare community reinvestment statements that report on various details of their lending activities. The law incentives expanded the availability of mortgage credit to low to moderate income applicants. Many believe that the CRA-driven increase in low to moderate income loans were a significant contribution to the economic crisis of 2008. Federal Deposit Insurance Corporation. The Federal Deposit Insurance Corporation was established by the Banking Act of 1933. It was designed to stabilize the ailing banking system of the time. In an effort to reestablish public trust, deposits were insured, first up to $50,000 and now up to $250,000. All member banks of the Federal Reserve Systems are required to join the insurance program. Non-member banks can request admissions and may be qualified join the program. Consumer Financial Protection Bureau. The Consumer Financial Protection Bureau is an independent agency of the federal government responsible for consumer protection in the financial sector. Its jurisdiction includes banks, credit unions, security firms, payday lenders, mortgage servicing operation, foreclosure relief services, debt collectors, and other financial companies operating in the United States. The CFPB's creation was authorized by the Dodd-Frank Act, whose passage in 2010 was a legislative response to the financial crisis of 2007 through '08 and the subsequent Great Recession. It was designed to consolidate employees and responsibilities from a number of other federal regulatory bodies, including the Federal Reserve and the Federal Trade Commission, the Federal Deposit Insurance Corporation, the National Credit Union Administration, and even the Department of Housing and Urban Development. The Bureau is an independent unit located inside and funded by the Federal Reserve. Sources of real estate financing. Sources of real estate financing include everything from commercial banks, savings and loan associations, and pension funds to your mother-in-law and next-door neighbor. Banks, thrifts, formerly referred to as savings and loans, pension funds, life insurance companies, and credit unions are typically highly regulated institutions. On the other hand, mortgage bankers and brokers, real estate investment trusts, limited partnership syndications, endowment funds, private loan companies, and individuals are not as restricted in their lending operations. Commercial banks and mutual saving banks. Commercial banks rely on demand deposits, primarily checking accounts for their supply of available funds for loans. Historically, commercial banks have not been a source of long-term real estate finance. Their real estate lending activity tends to be short-term, such as construction loans, home improvement loans, and mobile home loans. All of these are relatively short-term, high-yield loans. Mutual saving banks are mostly located in the Midwest and Eastern United States. They are organized as mutual companies, where profits are distributed to the depositors through interest or dividends. Arizona does not have mutual saving banks. Thrifts, formerly referred to as savings and loans. Savings and loans begin with the idea of pooling money for real estate loans. Legend has it that 10 friends each put $1,000 in a pot, and then each member drew a number. The person who drew number 1 was able to use the money first, then number 2, number 3, and so on, because savings and loans were first referred to as building and loans. They may well have evolved this way. According to the Society of Real Estate Appraisers, the first house in the United States to be financed by a savings and loan association was purchased with a $375 mortgage payable at $4.90 per month, of which $1.90 represented interest and $3 principal. The Philadelphia house, built in 1831, was estimated to have been purchased for $750. The concept of loaning funds only to members soon faded, and loans were made to other qualified buyers. As this happened, the attitude shifted more to serving the depositor, changing from building and loans to savings and loans. By paying their depositors compound interest, at times on a daily basis, they begin to attract a larger number of depositors. Savings and loans, called thrifts today, begin to offer a sell depository for savings as well as high interest rates on their deposits. Eventually, savings and loans were able to offer full bank service to everyone. Savings and loans associations had more flexibility than other regulated institutions. Through conventional loans, they can make loans in amounts up to and exceeding 100% of appraised value, but they usually only went as high as 80% loan to value without some form of private mortgage insurance on the loans. Until the savings and loan crisis in the late 1980s, these thrifts were generally the primary source of financing residential real estate. Today, thrifts are not a significant source of residential real estate financing. Life insurance companies. Although the sale of such life insurance products as whole life and life term policies remains an important part of the life insurance business, the primary business of life insurance company is no longer traditional life insurance, but the underwriting of annuities, contracts that guarantee a fixed or variable payment over a given period of time. Premiums collected by life insurers are invested primarily in government and corporate bonds. Although a portion is invested in mortgage loans, mostly commercial, today the total finance assets of life insurance companies exceed $4.3 trillion. Of that total, $282.7 billion, or 6.45%, is invested in mortgage loans. Life insurance companies also invest in mortgage-backed securities and make direct investments in real estate, as well as originate and hold loans on commercial properties. Loan originations are usually through company employees working with loan brokers, as well as directly with developers and investors, and also through mortgage bankers, acting as a correspondent for a life insurance company. Pensions and retirement programs. In the late 1800s, the American Express Company formed a retirement program for its employees. This pension plan idea found favor with railroad companies and utility companies. Employees set aside a portion of their earnings in a matching funds program with their employers. Money was deposited on a regular basis and withdrawn after retirement. So long-term, secure investments such as real estate loans were very popular. While pensions and profit-sharing plans were popular with those who were able to participate, plans were not available to most people. In 1974, Congress passed the Employee Retirement Income Security Act, a complete overhaul of federal pension law. The act made it possible for the smallest company, that is a sole proprietor, to have a pension or profit-sharing plan, or if an individual was an employee of an organization that did not offer a pension plan, then that individual could fund his or her own individual retirement account. Also provided for the protection of the assets set aside for pensions and retirement plans through the establishment of the Pension Benefits Guaranty Corporation. Today, these retirement benefits plans cover 150 million workers and contain assets exceeding $4 trillion. Real estate and real estate loans are very attractive investments for these plans because of the security and high rate of return. Credit unions. Credit unions are similar to the original savings and loans. They are operated primarily for the benefit of their members or depositors. The popularity of credit union comes from their ability to pay higher returns and charge lower rates on money borrowed. Credit unions now provide a complete variety of banking services, including mortgages and short-term home improvement loans. Mortgage bankers and brokers. Generally, a mortgage banker borrows money to make loans. This is done by means of a warehouse line of credit, usually made available by a commercial bank. The warehouse line is secured by the loans funded through it. The mortgage banker keeps the loans funded by the warehouse line in the warehouse until an investor purchases them, or they may be packaged and sold in the secondary market. As a mortgage-backed security, once the fund loan has been sold, the mortgage banker repays the warehouse line of credit. The mortgage banker continues to service the loan, which means he or she collects payments and receives a fee for this service. Or the servicing may also be sold in the secondary market. Mortgage bankers generally sell all their loans to investors or to the secondary market. Mortgage bankers are the major source of residential loans. A mortgage banker that represents loan originators, such as banks, life insurance companies, and pension funds, is called a mortgage correspondent. The correspondent represents the lender in a local community or territory and is paid a fee for originating, processing, closing, and servicing loans. A mortgage broker processes loans but usually has no funds to the loan. A mortgage broker processes loans but usually has no funds to loan. Once the borrower has been qualified and the loan processing has begun, the mortgage broker places the loan with an investor who funds the loan through an escrow. Once the borrower has been qualified and the loan processing has begun, the mortgage broker places the loan with an investor who funds the loan through an escrow. The mortgage broker receives an origination fee from the borrower, which is usually a percentage of the loan amount. The loan servicing can be done by the lender, investor, the mortgage broker, or an escrow or title company. In Arizona, mortgage bankers and mortgage brokers are required to be licensed by the Arizona Department of Financial Institutions. The secondary mortgage market. The secondary mortgage market is simply the purchasing and selling of existing mortgages and trust deed. It involves lenders selling mortgages to other lenders and investors. That may be called the primary mortgage market. Relates to loan originators, lending directly to qualified borrowers. The secondary mortgage market is simply the purchasing and selling of existing mortgage and trust deeds. It involves lenders selling mortgages to other lenders and investors. What may be called the primary mortgage market relates to the loan originators lending directly to qualified buyers. While many lenders who originate loans may retain some of them in their own investment portfolios, they undoubtedly sell off most of their loan production in the secondary market. Loan servicing, which involves collecting payments from the borrower and passing them along to the investor for a fee. Loan servicing, which involves collecting payments from the borrower and passing them along to the investor for a fee, may be separated from the sale of the loan, or it may be included. The original lender may continue to collect the payments from the borrower, passing the payments along the investor after deducting a fee for servicing the loan. Thus, the original lender may continue to collect the payments from the borrower, passing the payments along to the investor after deducting a fee for servicing the loan. Warehouse agencies are major buyers in mortgage loans. These agencies purchase large numbers of mortgage loans in pools. They use the pools purchase as collateral for their mortgage-backed securities, which are then traded in the securities market, much like stocks, bonds, or commodities. The following are the major warehousing agencies: Federal National Mortgage Association, Government National Mortgage Association, Federal Home Loan Mortgage Corporation, Federal National Mortgage Associations. The Federal National Mortgage Association is commonly known as the Fannie Mae. Federal National Mortgage Association. The Federal National Mortgage Association is commonly known as the Fannie Mae. Fannie Mae was established in 1938 as a government corporation to create a secondary market for FHA loans. The Federal Housing Authority program, which was established in 1934 to help rebuild the economy, was having trouble selling its mortgages to secondary investors to the national level. This meant they could not free up their money to reinvest in more loans. Therefore, Fannie Mae was established to provide stability and standards that would make FHA loans a lower risk investment. The FHA and its loan programs are discussed at length in Chapter 21. Fannie Mae guaranteed the success of the FHA program by providing a secondary market for the purchase of FHA-insured loans, replenishing necessary investor capital for funding more FHA loans. Private corporation. An amendment to the Housing and Urban Development Act of 1968 changed the Fannie Mae organization from a successful government-owned and controlled corporation to a private corporation. All Treasury-owned stocks were redeemed, and a matching amount of common stock was offered to the general public. Fannie Mae is now a profit-making organization, with its stock listed on the New York Stock Exchange. As a government-owned corporation, Fannie Mae was limited to purchasing FHA insured and VA guaranteed mortgages. As a privately owned corporation, it also purchased conventional mortgages as authorized by Congress in 1970. Purchase mortgages. Fannie Mae buys mortgages on a regular basis through a weekly auction. Mortgage bankers, savings and loans, life insurance companies, and other loan originators are major sellers of mortgages to Fannie Mae. Fannie Mae also sells mortgage-backed securities to investors in order to raise capital for the purchase of mortgage. Fannie Mae also sells mortgages-backed securities to investors in order to raise capital for the purchase of mortgage pools. The securities are backed by specific pools of mortgages purchased and held by Fannie Mae. Fannie Mae guarantees payments of all interest and principal to the holder of the mortgage-backed security. Fannie Mae receives no direct government funding or backing, and Fannie Mae securities carry a government guarantee of being repaid. Fannie Mae purchases mortgages. A signed servicing agreement allows the loan originator to act for a fee of servicing agent. The monthly fee is about 1/12.5% of the loan balance. This fee creates a considerable income for the originator, depending on the size of her portfolio. When Fannie Mae purchases pools of loans, lenders are able to roll over their money and loan it out again. Collecting more origination fees and more servicing fees, Fannie Mae has become one of the largest purchase and mortgages in the secondary market. In 2021, In 2001, Fannie Mae purchased over 40% of the loans produced in that year. For the year 2008, Fannie Mae purchases of lender-originated issues totaled $332.5 billion. In December 2008, their portfolio of mortgage loans exceeded $787 billion. Government sponsorships. Even though Fannie Mae is a privately owned corporation, it is still under government sponsorship. The board of directors has 18 members who serve one-year terms. The President of the United States appoints 5 members and stockholders elect 13. On September 6, 2008, the Federal Housing Finance Agency was appointed as a conservator for Fannie Mae and succeeded to all its rights, titles, powers, and privileges. In 2010, Fannie Mae stock was delisted from the New York Stock Exchange and now trades in over-the-counter bulletin board. In 2015, the conservatorship remains in effect. Government National Mortgage Association. The Government National Mortgage Association is a government corporation under the control of the Department of Housing and Urban Development. Ginnie Mae, as it is called, administers special assistance programs and works with Fannie Mae in secondary market activities. Ginnie Mae does not purchase mortgages. Ginnie Mae does not purchase mortgages. Its function is to guarantee the payment of principal and invest on a pool of FHA Farmers Home Administrations or Department of Veterans Affairs mortgages. Ginnie Mae does this by issuing a security called a pass-through certificate to the investor in the pool or mortgages. Because Ginnie Mae is a government agency, its guarantee is backed by the full faith and credit of the U.S. government. Typically, securities dealers who trade in Ginnie Mae securities purchases with security issued. The Ginnie Mae pass-through certificate is a security interest in a pool of mortgages that provide for a monthly pass-through of principal and interest payments directly to the certificate holder. Federal Home Loan Mortgage Corporation. The second major player in the secondary mortgage market is the Federal Home Loan Mortgage Corporation, known as Freddie Mac. The Emergency Loan Finance Act of 1970, which gave Fannie Mae the power to purchase conventional loans, authorized the establishment of a new player in the secondary market. Originally created to provide a secondary mortgage market facility for members of the Federal Home Loan Bank system. Savings and Loan Associations. Freddie Mac's charter has been modified to include all mortgage lenders. Freddie Mac is now a publicly owned corporation similar to Fannie Mae, and Freddie Mac is now a publicly owned corporation similar to Fannie Mae and listed on the New York Stock Exchange. However, like Fannie Mae, the Federal Housing Agency was appointed as the conservator of Freddie Mac on September 6, 2008 and 2010. Freddie Mac stock was delisted from New York Stock Exchange and now trades in over-the-counter bulletin board. In 2015, the conservatorship remains in effect. Through the years, Freddie Mac has become the largest purchaser of conventional loans in the secondary market. During 2008, Freddie Mac purchased mortgages totaling $321 billion and retained a portfolio that exceeded $804 billion as of December 2008. Freddie Mac finances its mortgage purchases through the issuance of a mortgage participation certificate. These guaranteed mortgages securities are sold to the public through security dealers. Freddie Mac ultimately assumes the risk of borrower default in respect to these securities.